Gross margins for SMCI have compressed to approximately 9.5%, underscoring the harsh realities of the hardware business. Even for a company that operates at the highest level of engineering excellence, competing for massive hyperscale contracts against industry giants like Dell demands aggressive pricing. This price competition inevitably eats into margins, a reality that is now front and center for investors and analysts alike. On investing forums and platforms, the debate has intensified. Can SMCI realistically return to double-digit margins, or is this level the new normal for the business? For investors who rely on managed portfolios, such as Schwab Intelligent Portfolios or other online investment tools, exposure to SMCI is often bundled within ETFs. This provides a buffer against the margin volatility that comes with direct investment in hardware companies. For self-directed investors, however, holding SMCI stock directly requires a high tolerance for swings in profitability and operating leverage. The company's financials and operational updates need to be monitored closely to navigate the inherent risk. A significant shift in revenue dynamics emerged late last year, which remains a critical factor in evaluating SMCI. In its most recent quarterly report, SMCI missed its $6 billion revenue target by roughly $1 billion. The company attributed this shortfall not to weak demand, but to a timing issue. Several customers delayed purchases as they requested upgraded configurations featuring the latest NVIDIA Vera Rubin platforms. This pushed a portion of the anticipated revenue into the subsequent quarter. While the market initially reacted with skepticism, recent price action suggests that confidence in the company is gradually being restored. Should SMCI successfully deliver on its $10–11 billion guidance for the next quarter, the potential for a significant short squeeze exists, highlighting the volatility and opportunity inherent in this stock. Investors often draw comparisons between SMCI and companies like NVIDIA or Apple, but these comparisons can be misleading. Unlike NVIDIA or Apple, which operate with relatively predictable supply chains and mature production processes, SMCI functions largely as a massive assembly and engineering operation. The company is highly dependent on component availability, meaning any supply chain disruption can materially affect revenue and margin performance. Institutional activity in SMCI has been varied. While some large wealth management firms and brokerage accounts, including Fidelity, have trimmed their positions, others are actively bottom fishing around the $30 per share level. The recent securing of a new credit facility signals to the market that the company is less likely to face a liquidity crunch, mitigating one significant risk factor. Despite these improvements, a governance discount persists. Even after bringing on new advisors, such as George Kao, and switching auditors, the market remains cautious. Investors are waiting for a clean, fully audited annual report before fully trusting the numbers again. This uncertainty explains why SMCI trades at a forward PE of roughly 14, considerably lower than its peers in the sector. For self-directed investors managing individual brokerage accounts, timing entries in SMCI is particularly challenging. A news headline about a new partnership on platforms like Robinhood can prompt a purchase, only for the stock to drop the following day due to broader sector-wide sell-offs in semiconductor and data center infrastructure companies. Currently, sector momentum favors firms capable of providing complete AI factory solutions, not just individual servers. SMCI aims to position itself in this space with its data center building block solutions, which theoretically could carry higher margins in the future. However, to date, quarterly results have yet to reflect significant margin expansion. Understanding SMCI's business model is critical to assessing its potential. The company does far more than assemble off-the-shelf components. It designs motherboards, power supplies, and cooling systems in-house. This vertical integration is intended to improve efficiency and control, giving SMCI an edge in operational execution. Their DLC-2 liquid cooling system, for example, is engineered to reduce data center power consumption by up to 40%. In an era where power constraints limit AI growth, this innovation represents a meaningful competitive advantage. However, being an engineering-first organization can create challenges in sales and administrative oversight, a factor that contributed to the accounting issues the company faced last year. The competitive landscape in 2026 is markedly more crowded than it was just 2 years ago. Dell has aggressively expanded into liquid cooling solutions, and HPE's acquisition of Juniper Networks provides them with networking capabilities that SMCI currently lacks. To remain competitive, SMCI must continue to prioritize speed, flexibility, and engineering innovation. Expansion of their manufacturing footprint in Malaysia and Taiwan is underway to accommodate the anticipated order surge in the second half of 2026. The company is targeting $36 billion in total revenue for the fiscal year, a substantial leap from recent levels. Achieving this target could make SMCI's current $19 billion market capitalization appear undervalued, while a miss could create a sharp downward correction. For investors using platforms like Fidelity Investments or Fidelity Wealth Management, SMCI is typically included in tech-heavy mutual funds or sector-specific ETFs, offering some degree of stability. The stock remains highly volatile for individual investors, however, with 10% daily swings making it a favorite among Robinhood traders. SMCI exemplifies the type of security that can have an outsized impact on a portfolio in a short time frame. Monitoring the cash conversion cycle is essential. It recently increased from 96 days to 123 days, indicating significant inventory accumulation. The company is betting on a smooth ramp-up of the Blackwell Ultra systems, but any further chip supply delays could turn inventory into a financial liability. Looking ahead, several catalysts could materially influence the stock's trajectory. First, the filing of audited financials could remove the largest overhang on the stock, restoring investor confidence. Second, the upcoming Q2 earnings call will clarify whether the shifted revenue actually materialized. If SMCI reports revenue closer to $11 billion, it would validate that demand remains strong and that the prior miss was solely due to configuration timing. Third, news regarding partnerships with hyperscale data center operators in the Middle East, such as DataVolt, could add billions in potential revenue over the coming years. Bulls envision SMCI as the Cisco of the AI age, an infrastructure giant poised to dominate the data center sector. Reality, however, is more nuanced. SMCI is currently an exceptionally fast-moving and efficient hardware integrator, but it faces intense competition from larger, more established players. While it has a clear engineering advantage in liquid cooling technology, governance and internal controls remain areas of concern. For long-term investors using SoFi Invest or similar platforms, the critical question is whether management can maintain rapid growth, potentially 50% year over year, while addressing internal operational and governance challenges. Few companies have successfully executed this balancing act. The broader macroeconomic environment also plays a role in shaping SMCI's prospects. Stabilizing interest rates in 2026 would reduce the cost of carrying $5 billion in inventory, easing pressure on working capital. Conversely, any slowdown in AI spending from major hyperscalers like Microsoft or Meta would disproportionately affect SMCI, given its reliance on enterprise-scale demand. Unlike companies such as Apple, which benefit from recurring consumer services revenue, or Tesla, which has a highly visible product ecosystem and brand loyalty, SMCI's fortunes are tightly linked to enterprise demand cycles and supply chain dynamics. In conclusion, SMCI represents a high-risk, high-reward opportunity in the current market. Investors must weigh its engineering leadership, expanding manufacturing footprint, and innovative cooling solutions against persistent margin pressures, governance concerns, and supply chain vulnerabilities. Those willing to navigate the volatility and monitor key operational indicators, including cash conversion cycles, configuration delays, and major partnership announcements, may find substantial upside potential. Others may prefer more stable exposure via ETFs or mutual funds, where sector exposure is balanced with lower individual stock risk. The coming quarters, particularly Q2 earnings and audited filings, will be pivotal in determining whether SMCI